Introducing Ausbiz Capital GrowWise, a new fund which combines institutional insight and experience with a target return of 15% per annum.
Our fund mirrors SciTech GrowWise, backed by an 18-year track record with historical 21% average annual net return. With more than $1.45 billion under management, the SciTech GrowWise Fund is led by award-winning global portfolio manager Ivan Sherman. The same strategy is now available to Australian investors from as little as $5,000. Discover Ausbiz Capital GrowWise, investing informed by experience.
Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here again at Ausbiz. Let's check what happened overnight. Global shares hitting fresh record highs as markets position for the US Fed to resume its monetary policy easing cycle this week. The three major US stock indices closing high, with the S&P 500 and Nasdaq once again closing at record highs. Tesla shares accelerated after it was revealed Chief Executive Elon Musk acquired nearly $1 billion worth of the EV maker's stock on Friday. Nvidia was relatively flat after China's market regulator said it will continue an investigation into the AI chip leader after preliminary findings showed it had violated the country's anti-monopoly law. Shares of Google parent Alphabet rose to hit a market capitalisation of $3 trillion for the first time. Intel lowered its full year 2025 adjusted operating expense target to 16.8 from 17 billion to reflect the deconsolidation of its programmable chip business Altera. And declines in McDonald's and Procter & Gamble weighed on the Dow. And CoreWeave shares surged after the data center operator signed a deal with Nvidia that guarantees that the chipmaker will purchase any residual cloud capacity not sold to customers. That deal initial value at about $6.3 billion. Well, US and Chinese officials have reached an agreement to switch short video app TikTok to US-controlled ownership. That will be confirmed in a call between US President Donald Trump and Chinese President Xi Jinping due to take place on Friday. The social media app has around 170 million US users, and the deal is a rare breakthrough in month-long talks between the world's two largest economies. Meanwhile, Asian manufacturing activity in New York has come in below expectations as investors prepare for the upcoming policy announcement from the Fed later this week. And further signs of weakness in manufacturing saw US Treasury yields decline further, the yield on the 10-year note falling to 4.03% and the 2-year at around 3.53%. The US dollar weakened across the board as investors wait for the Fed to resume its interest rate cuts this week. The Aussie climbing to 66.7 US cents, and Bitcoin is trading at around 115,000 US dollars. Oil prices have risen on concern over the impact of Ukrainian drone attacks on Russian refineries, and as President Trump presses NATO nations to halt Russian oil purchases. Brent crude futures up at $67 a barrel. Copper was up around 1.5%. Iron ore falling marginally to 105 US dollars a tonne, and gold rising to another all-time high as the US dollar and Treasury yields fell ahead of the Fed meeting. Spot gold up 1% at around $3,680 an ounce. Let's get more with a focus on Wall Street. Steve Sosnick is the Chief Market Strategist at Interactive Brokers. He joins again now. Steve, welcome back. Good to see you. So more records. I think every time I talk about records on Wall Street, just an indication of the momentum we're seeing. What's driving that?
Good morning, Andrew. Momentum begets momentum. I think, first of all, it's sort of a fait accompli, right? I mean, if you're already at a new high and you go up the next day, well, then it's another new high. And so I think what's going on here is we're in the midst of a bit of, I'm going to call it even a little euphoria, just, on the idea that the momentum will be self-sustaining, on the idea that we're going to continue to see favorable conditions in markets and basically an environment where, for all lack of a better term, all news is good news.
Well, obviously also positioning for the Fed. What are the expectations there, Steve? I guess there are a couple of scenarios at play here. Can we discount no move? Is it more about do they go 25, do they go 50?
Yeah, I think it's down to it's 25 or 50 at this point. If they were going to not move, they would have had to signal it, because the Fed is not they're not big on the idea of just shocking markets unless they need to be shocked. And I think that right now there's no incentive for them to basically do anything less than 25. I do think that that's all we get though. Actually, my terminology here is I think we get a hawkish cut. And the reason I say that is, if you look below the surface, inflation is actually steadily creeping higher. Not aggressively, but it is a little bit. For example, we had the big rally last week because the core CPI came in as expected at 0.3. Fabulous. Now, headline CPI rose 0.4. That was above expectations. That was forgotten. But the core CPI, when you took it out to 3 digits, because they always take it only out to 1 digit, it was 0.346. Literally, you were basically an eyelash away from them rounding that to 0.4. And so how would the market have reacted if inflation was 0.005% higher? We would have had a completely different market move. And also in the Fed's most recent statement of intentions, long-term intentions, I may have the wording exactly wrong, but basically they came out and reaffirmed the idea that stable prices are a prerequisite for full maximum sustainable employment. Well, there's been a lot of talk as to which side of the dual mandate does the Fed favor, and of course, the thought has been that they're favoring the slowing labor market as their impetus to cut. But I think they're going to basically put out some messaging that says, wait a minute here. Okay, we maybe even in the dot plot might signal 2 more 25 basis point cuts, but they're not a necessity. They're not necessarily going to happen. And, and so they remain data dependent. That may not be what the market wants to hear.
Well, I mean, speaking of the market, what's the likely reaction if it plays out as you see it, given the equities there are priced to perfection?
Well, if it plays out as I see it, we're looking at a buy the rumor, sell the news scenario, because the news will not be what the market wants, because the market essentially is pricing in rate cuts from here on out. And they may get it later on down the road because, ultimately when Chairman Powell's term ends, he'll presumably be replaced by someone who's much, much more dovish. You're getting a new governor. In theory, I've not actually seen the headline to say that Stephen Myron has been confirmed, but there's the possibility that a new, very dovish governor is going to show up. We've also not seen any word from the appeals court saying that they were going to allow Lisa Cook to be fired before tomorrow's meeting. So you've got all that working its way through. And so this is why, and ultimately, we don't necessarily, I'm going to argue we don't need a rate cut so much, because I've asked various people this. Tell me what the current level of rates is impeding anyone from doing. Certainly not impeding investment in stocks or other asset classes, Bitcoin, highly speculative stocks, et cetera. It's not impeding credit. The credit is plentiful and easy to come by. Credit spreads are almost as tight as they've ever been. The yield curve is certainly well under control. It's steepened a little bit, but still relatively flattish. So exactly tell me what the level of rates is preventing us from doing. Sure, I guess if capital gets cheap enough, then maybe companies can devote some more of their money, that found money, to labor, but it's not a one-for-one thing. So I think that there will be a little bit of caution here, and maybe a reminder that although the Fed says we're a little bit restrictive, maybe we're not quite as restrictive, and the markets won't really like that, considering that they've just been on this. They've been in party mode basically since Jackson Hole.
Well, Steve, good luck trying to convince your president of that reasoning.
Exactly.
Reaction is going to be post that decision and the commentary from the Fed chair. Look, also, stocks getting a bit of boost too from those US-China trade talks, in particular, obviously a bit of a breakthrough there in regard to TikTok, but then Washington received a bit of a backhanded there in regards to Nvidia with those findings showing that, in fact, it's violated China's anti-monopoly laws.
Well, I mean, these are back and forth negotiations, and I think we would be extraordinarily naive to think that China doesn't know what the pain points are for the U.S. That's part of the back and forth, and I think that the, this violation of that they're alleging happened in 2020, and it's just coming out now while they happen to be sitting across the table from each other in Madrid. Um, this is part of the back and forth of trade. I think that's kind of why the market essentially shrugged it off. The stock wasn't particularly lower in our overnight trading, and then it was basically back to unchanged by midday. So I think it's back and forth. This is what happens. They don't have a although there was some decent happy talk coming out of the speech, the various parties today, which is a good thing. I think we all want global trade to continue. I think it would be naive to think otherwise, that China was just going to roll over and say, "Oh, here, you do what you want. We're not going to go after anything that might bother you guys."
Gold, almost behaving like a risk asset at the moment, isn't it?
Yeah, funny that way. I mean, it's wild. This is like back to the '80s for me. My first gig was trading metal stocks. Um, and global metal stocks, which meant I was up. I had a lot of long nights with people in Australia on the phone back when it was all done on phones. And so this is kind of this is fun. I think I think central banks got the ball rolling, so to speak, because I do think think of how much of this has picked up since the election and inauguration. I think there's been sort of a move among central banks to move some of their excess reserves, if not away from U.S. dollars, but certainly adding them to gold rather than U.S. dollars, and diversifying away. So that's one thing. Remember, I've come on here many times and said, in my mind, gold is more of an anti-dollar than it is an inflation hedge. But on top of it, you have U.S. rates coming down, so therefore lowers the opportunity cost of holding gold. You also have an environment where risk assets are in vogue, and once momentum kicks, gold is by no means immune from a momentum trade itself, and so you throw all that together, and you've got a very powerful rally.
Steve, terrific to catch up with you again. Look forward to unpacking what we hear from the Fed later this week. Thanks for joining us on Interactive Break.
My pleasure as always. Take care, Andrew.
Steve Sosnick from Interactive Brokers. All right, let's check the local market ahead of the open here, and looking for a very solid start. SPI futures up almost 0.5%. We're going to get right across that in just a minute or two. Stay with us.